It's Brian Preston, the Money Guy.
Go ahead and bring up the traditional 2017 1040. Here's what I think is interesting. When you look at the 2017 form, this is what it's looked like for years, really for probably the last 30 years. There's been some changes, added a few line items. But it starts off, you've got your basic information top, your name, social security number, your dependents. Then you go through your income, adjustments to your income. Page 2, we had our taxes and credits. And then you had your other taxes. That's where they caught you up on self-employment taxes, alternative minimum taxes, and those type of things, all the things you dreaded. And then about 2/3 of the way down the page, you had your payments. That's where you had all your tax withholding from your paycheck. You had your estimated tax payments, extension payments. It was all right there. And then at the bottom, you either got told, hey, you owe money, or you get a refund.
That's right.
All here on 2 pages. So when a prospect or a brand new client, when I said, just give me your first 2 pages of your tax return, plus give me your Schedule A, I could pretty much tell you what you had going on in your financial life.
And I don't want to say it was simple, because I don't think anybody would argue that our tax code was simple.
No.
But again, there was some familiarity with it.
It was consolidated.
Exactly. Once you got the flow down, you could get a lot of information very, very quickly from the original tax return.
So that's old. Out with the old, in with the new. Bo, bring up the 2018 tax return. So here's what I want you to notice. We didn't cut off the bottom half of that page. Scroll down, Bo. Show them the second half of that form.
Oh, you just mean all the blank white
Keep
space
going.
at the bottom of the form.
I think the designer of this thing was an owner of a paper company. Look at it. It is now half the page is unused. So page 1 now on the 1040 for 2018 is just going to have your personal information. It's going to have your name, your social security number, your dependents, and your signature line. So they brought page 2 to page 1 on the signature.
That's right.
No other information besides your personal information. Page 2 is just going to kind of be a summary of what you had going on, whether it's your income, your wages, and then basically if you overpaid or if you're getting a refund, it's all right there. And if there's a whole Q&A that the IRS provided, because people say, well, why did they redesign the forms completely? And they said, look, we wanted, instead of having a 1040EZ, instead of having a 1040A, instead of having a 1040, we wanted to have just one form that had the flexibility for us, the building blocks for us to make changes in the future.
So they wanted everyone who files, no matter someone starting out or someone who's got the crazy complicated tax situation, to start with the same base, is what they were hoping for.
So it's the same, and their terminology was building blocks.
Building blocks.
They want everybody to have the same building blocks, so it doesn't matter if you're super sophisticated or ultra easy, you're going to file the first 2 pages.
Okay.
So that kind of makes sense. I just don't understand the spacing and the blankness at the bottom of the pages. So, and then here's where additional details added, because in addition to changing Form 1040, they now added Schedule 1, 2, 3, 4, 5, 6.
Now, Brian, you must be confused, because I know schedules, and there's like schedules A and B, and schedules don't have numbers. They're like schedule A, B, C,
We've
D,
added
E.
Schedule 1, 2, 3, 4, 5, and 6. And I want to kind of go through each of these really quick, kind of give you a tour. So Schedule 1, if you could pull that up, is the additional income and adjustments to income. Now, what you'll notice is this stuff looks like the old 1040, page 1. You're going to have your additional income, that's your refunds, that's your business income, capital gains, those type of things. And then you'll also have adjustments to income.
Right.
This is all the stuff at the bottom, like educator expenses, the IRA contribution, your IRA deduction, your student loan interest, all those things you're used to. But instead of being on page 1 at the bottom half of the return of your 1040, it's going to be Schedule 1.
And that's all Schedule 1 is those 2 pieces, actual income and then adjustments in income. And that used to be the bottom of the page 1040. So
and at least it takes up 2/3 of the page. Because when you see Schedule 2 with the title of Tax, this one cracks me up. I mean, this one, they couldn't have brought this and made Schedule 1 and 2 combined, because
or just call
when
it
you
something
see
completely
this
different.
form, all that's on this form called Tax, Schedule 2, is alternative minimum tax, and then the excess premium return, where if you made too much money with the Affordable Care Act, because you're getting credits on your insurance premiums. If you made too much money, this is where you'd pay it back, plus your alternative minimum tax. This is going to be your least favorite form if you're doing your taxes, I would think, because this means you're in uh-oh land.
So not everyone is going to. So everyone is going to have the first page of the 1040. Most folks are going to have Schedule 1. They're going to have some sort of income or adjusted income.
Yes.
But not everyone's going to have Schedule 2. That's one that may or may not flow.
I think the majority of people will not have Schedule 2.
That. Okay.
Schedule 3 is going to be non-refundable credits. When you look at Schedule 3, this is where this was typically about a third of the way down on page 2 of the 2017 and before 1040s.
Okay.
Because this is where you get your foreign tax credits, your child tax credits, which are going to be huge under the new tax legislation, retirement savings credit, the residential energy credit if you made some improvements on your house. All that stuff, this is going to be a favorite.
And you said non-refundable credits, right?
Yes, this is non-refundable credits.
So non-refundable credits, just a quick recap of what that is. What's the difference in refundable and non-refundable?
That means if you don't have enough income to generate the taxes, these credits cannot be refunded to you. Meaning that if, say you have a child tax credit, now that's what's interesting, that means the child tax credit must be also listed somewhere else.
It is, because there's a portion of it that's refundable, portion of it that's not refundable.
That's exactly right.
Yep. And I think what they did is, I was reading an article on this, they made the math so that essentially it works out the same as it has previously, even though the child tax credit doubled year over year. So it's going to
probably show up in multiple places. So, but this is your non-refundable credits, meaning that if you don't pay enough taxes, they will not generate an additional refund just from the credits. Number 4, Schedule 4 was other taxes. This is where you're going to have your self-employment tax. This is where you're going to have underreported Social Security and Medicare taxes and things like that. Additional taxes on your IRAs, like your early withdrawal penalties, things, no-go land that you don't want to be in. And then household employees. If you have an employee, or cleaning service, something like that, this is where you pay all that. So it's kind of interesting. Schedule 4 is those other taxes. And then Schedule 5, this looks like the bottom of page 2 of your original 1040, which was other payments and refundable credits. Now this is where you got the child tax credits and as well as your payments, estimated tax payments, all the things you're taking credit for. And then 2016 is pretty much another nothing burger. This is if you have your Schedule 6 is foreign address and third-party designee. Now, I was curious, all the tax preparers out there, I said, I wonder if they're automatically completing this, because it used to be just a box that you would want to give your tax preparer permission to talk to the IRS if there was ever a discrepancy. So I've got to believe a lot of people who use paid tax preparers will probably be completing Schedule 6.
So we've gone through these 6 schedules that follow the initial page. And unless I'm missing something, it doesn't sound to me like there was anything on those 6 pages that was not previously contained on the first 2 pages of the 1040.
That's pretty true.
So all we really did was just spread them out. It's not like we added anything or changed anything. The operation behind some of the lines might have changed, but the lines themselves are the same as it was. It's just now we have 6 pages instead of 2. Is that my putting that together?
That is a pretty true statement. And here's the other thing I thought was interesting. And you kind of said this in the beginning, Bo, is that we added Schedule 1, 2, 3, 4, 5, 6. I get, if we're simplifying the process, we have pages 1 and 2. Page 1 is just basically your personal information. Page 2 is actually a summary of all the things. And then you have the Schedules 1 through 6. That's probably it if that's all you're filing.
Right.
Here's the crazy part. There's still a Schedule A, which is itemized deductions. There's still a Schedule B for your interest and dividends. There's still a Schedule C if you have self-employment income. There's still a Schedule D for capital gains transactions. There's still a Schedule E if you have flow-through income from a K-1 or rental property. There's still a Schedule F if you have farm income. I think it's madness.
So we've added 6 new schedules, but we kept all the old schedules we still had with the previous tax filing forms.
So like I said, we're just doing a tour, and then we're going to get into the planning opportunities that we see with the 2018 tax code. But this is not for somebody who wanted to consolidate this thing. Remember, I heard a lot of our elected officials talk about how they wanted this on a postage, a postcard.
Yeah.
I don't know if they wanted each top of the page to be postcard eligible, but I don't know that we headed towards postcard territory by adding all these different schedules. And it's just kind of out there a little bit to me. I did want to talk about itemized deductions. Schedule A changed a bit too.
I would say it changed a lot because there was there was a huge, big change that took place that the standard deduction. I think a lot of folks who previously were itemizing are probably going to be in the place now where they might not be itemizing anymore.
There's going to be a lot more of you that are going to take the standard deduction rather than itemizing. Because as Bo explained, what used to be like a $12,000 standard deduction has gone to $24,000 for married couples. Single individuals is $12,000. That's substantially higher. Now, what has gone away is that your personal exemptions. I mean, if you were a person that had 4 kids, 5 kids, you got to count a personal exemption on every one of them.
It was like $4,050, I think.
That's all consolidated into the process now. So that has gone away. And that leads to Schedule A, which is your itemized deductions. Few of you are going to need this form, but I want to kind of tell you the things that have changed and the things to pay attention to. And we're starting to get into the planning.
This is the planning stuff. All that beginning stuff was just kind of the logistics.
That was a tour of what's really changed. So here's what I think is interesting on, like when you look at your itemized deduction schedule, you'll notice medical is always at the very tippity top. And when we had the last tax reform or update to the tax code, I was kind of disappointed that medical expenses, because it's always, and this bothers me. I will tell you personally, I don't like that they do this. Medical expenses, you don't get to deduct unless they exceed a certain threshold of your income, and that percentage changes.
That's right.
Over the past, it used to be 7.5%. That was kind of a standard for many, many years. And then, within the last decade, it went to 10%.
So even if you had medical expenses throughout the course of a year, you would have to, those expenses in total would have to be greater than 7.5%.
Let's give an example. It's going to be easier with an example. If your total income is $100,000, in the past, if your medical expenses didn't exceed $10,000, none of your medical expenses were deductible. And where did I come up with that $10,000? It was because it was 10% of your total income. So the threshold for deductible medical expenses was it had to exceed 10% of your adjusted gross income before it was deductible. That number has now gone down to 7.5%. So the same person that makes $100,000 or couple, now that number is $7,500. So same example, if you had somebody who had exactly $10,000 of medical expenses, in the past, they wouldn't get to deduct any of them because they didn't exceed $10,000. Now, in 2018, they'd get to deduct $2,500 of medical expenses because the threshold went down to 7.5%.
So for years where you have big medical expenses, it's pretty significant. I think that'll make a difference for a lot of folks.
So let's move on to something that some people are not going to like as much, and that's the taxes you paid.
That may be the most watered down version I've heard anyone say that, because I know a lot of folks who are just really fired up about this because there's some huge tax implications to it.
Yeah, it's the SALT limitation. The state and local taxes have now been capped at $10,000.
Yep.
So if you live in a low tax state where your property taxes are low, you don't have high, sales taxes, you don't have any income taxes in your state, this doesn't impact you.
That's right.
Unfortunately, if you live and it's on the west and the East Coast, higher tax states, you got crushed by this. Now, I will tell you, fortunately, I want to tell everybody to take a deep breath because I had a client in Virginia that they were really panicked about this. Did some tax projections for them, and the savings from the tax rates, because remember, everybody's tax rates went down, even with the loss of the local taxes, or the cap, I should say, of $10,000. When we did a tax projection for them at the end of last year, it still showed that there was some tax savings. So I want you to take a deep breath. Some of you still might benefit from the revised tax policy because just the lower tax rates. But there are some of you, especially if you're a higher income person in a higher state income tax area,
you're going to feel this.
You're going to feel this one. So just pay attention to that. That is a big change that has occurred. Interest you paid, we're not going to get into details because it's kind of past, but what is deductible mortgage interest on new homes has changed. Your mortgage lender, your real estate agent is going to explain that, because if you were grandfathered in, if you had an older loan, that stuff didn't really get impacted, but it's only primarily for newer people that came in. So pay attention to the interest you paid. Otherwise, there was not that big of a change on that. Gifts to charity. Because of this is a planning opportunity. Nothing really changed on gifts to charity, but you do need to change the way you think about gifts to charity. And we're going to come back to QCD in a minute too. I don't want to move past that completely, but gifts to charity, because of the standard deduction being twice what it used to be, there's a good chance you give to church or give to your favorite charity, you might not get to itemize like you did.
Not unless that and all your other deductions are greater than $24,000 for a married couple or $12,000 for an individual.
But that doesn't mean that you couldn't consider lumping, or grouping your charitable contributions. And if you want to keep the cash flows consistent to your favorite charities, I always tell people, go look at some of those charitable gift funds that you see at Charles Schwab, Fidelity Investments. They have charitable gift funds where you can contribute to their charitable gift funds, take the deduction in the year, that's how you're going to do the grouping, and then you control the cash flow of when you want to disperse those gifts or those benefits to the charities that you so want to support.
That's exactly right.
I had it on here. Keep me on pace, Bo. Qualified charitable distributions. Is this the time to talk about it, or do we do it later?
No, it's huge. QCDs are a huge opportunity that have been around for a while, but in 2018, I think they're going to be even more valuable because of how the standard deduction changed.
Yeah, I mean, the biggest thing, we'll come back to it. I'll talk about it a little bit more, but that's probably a great place to leave it. Another big thing you'll probably notice on the Schedule A of what has disappeared from this form. The big part is your investment advisory fees, your tax prep fees.
Safe deposit box.
Your safety deposit box, your unreimbursed employee expenses. So all my salesmen out there, they're driving 40,000 miles a year, you're feeling this. And the fact that your miscellaneous itemized deductions are completely gone off of Schedule A. If your employer, if you are one of these people that has huge deductions from those unreimbursed employee expenses, you might need to be having a discussion with your employer, because you're probably recognizing that on your tax return. That's huge. So that there needs to be some discussion on that.